Thank you, Joe, for coming. It's a beautiful spring day, and then you look very springy, but it's not spring in the equity markets at least. We saw the biggest sell-off, leading NASDAQ, right? In all the equity markets, all the indexes were down, and it continues. What do we owe this sell-off to?
Okay, well, I think two things. One, from a fundamental perspective, we've got the external sector, ex-US, looked like the global economy slowing a bit. So firms are concerned about demand from emerging markets, China and Europe. Second, now while I'm not an equity analyst, I'm an economist. So the way I look at equity markets in terms of their valuation is to use something called Tobin's Q, which is James Tobin, the Nobel-winning prize economist from MIT, invented back in the 60s. It gives us a way to fairly value fundamentals. And at the end of 2013, Tobin's Q suggested strongly that equity markets were overvalued. Now, going back to 1950, the average is 0.71, which tends to tell investors buy equities. But at the end of last year, it was saying don't, sell equities. So I'm not really surprised, given what's happening at the Fed, where they're slowing the asset purchases each month down, will likely be finishing at the end of the year, that investors are reassessing their appetite for risk, especially, again, in the context of a slowing global economy.
Well put, from an economist point, the senior economist, Joe. Well, you told me about Fed, right? Fed, we saw the FOMC, and it didn't surprise us, yes, but they were talking about dropping the unemployment, the targets, and everything before. What do you expect going forward? Are we going to see any surprises just like that? It didn't calm down the markets. Only for one day, maybe it did, but it wasn't sufficient enough to calm down. Do you think, given the situation in the equity markets and given the economic conditions, they're going to change their position? Do you expect such a move from them?
No, I don't expect them to change their position. And I think what's important for international investors to understand, in terms of the U.S.'s monetary policy, we've had a real change of regime. We've moved away from the quantitative target associated with the unemployment rate to a qualitative set of forward guidance. So we've moved away from rule-based monetary policy back to discretionary monetary policy, which is where we were from 1950 to 1986, right? So this is a different world. When you strip policy of its nominal anchor, you should expect some rate volatility, which is exactly what we saw after the FOMC meeting. So anytime we see FOMC actors speak, next week we've got 7, Janet Yellen's going to speak twice next week. It wouldn't be surprising to see some rate volatility surrounding any Fed talk, FOMC statements, FOMC press conferences. So you want to watch that differently. Now what the Fed's going to continue to do is jawbone markets to suppress longer term yields. The Fed's policy is lower for longer. And what they're doing is they're using their forward guidance to communicate to both domestic and global investors that the U.S. 10-year rate should remain somewhere between 2.5 and 2.75. And the policy rate, the federal funds rate, is likely to remain at 0, at least until the end of 2015, perhaps even early 2016.
And, giving the spring again, let's go back to that,
Sure.
and then the bad weather is behind us. Some of the economic data is smiling at us.
Yes.
Can we say that?
Yep.
Are you optimistic? And I never see you optimistic about this. Are we bouncing back? Where do you see the economy going?
Well, there's a couple things here. I'm still very cautious, but I'm fairly confident that the data in April and May is going to look a lot sunnier, a little bit more robustness. Now, what's happening is a couple things. First, we had a very 2-month period of winter, two very bad months of severe winter here in the United States, where we saw a declining consumption, a loss of working days, and lower production. So what tends to happen is when the weather eases up in the spring, you get a springtime rebound. And we're already starting to see evidence of that. So growth's going to look a little bit better than maybe we thought, perhaps 2.8 to 3% here in the second quarter of the year. Now the first quarter of the year is going to be very bad. If we get to 1%, we'll be lucky. But there are some risks here, and we want to bear those in mind. The first is the slowdown in housing started in the second half of late last year and doesn't look like it's abated. Second, we need to see household deleveraging wrap up and consumers really hit the accelerator and spend right through any turbulence that we see this year. And third, we need to see big firms increase capital expenditures, because that's the virtuous cycle of capitalism. CapEx begets hiring, hiring begets spending, spending supports a more sustainable period of growth.
I'm glad you mentioned the third one, companies, and the first quarters are being released.
Yeah.
What was the effect of the bad weather? I mean, because all the expectations of the profitability is being lowered, right? All the
Yes.
forecasts. American Airlines said, what, $155 million they lost because of the bad weather, and Macy's closed 244 stores. I don't know even the whole impact in terms of monetary in the retail, but are you a little also pessimistic, like many other forecasters, in terms of the first quarter results?
I would expect some very difficult earnings statements here over the next 2 months. You know, the airlines clearly got hit by the weather. What's going on in the retail sector is a little different. They may point to the weather. It's not the weather. We've got a revolution going on in retail here in the United States. As the consumers trade down, people are making adjustments in terms of expectations of income and how they spend, right? So Macy's is recognizing that the bricks and mortar stores for them is becoming less relevant, and they're moving to a more online presence. Two, in terms of Family Dollar stores, which is where our lower income cohorts spend, we had the end of unemployment benefits and food stamps. That's hitting places like Walmart and Family Dollar disproportionately. So that's what's happening there. They might have seen a little bit of a weather effect, but they got much bigger issues.
And this is my last question, Joe. So where do you see the strength? Retail is a different story.
Sure.
Housing is a different story. I'm very interested, by the way, by your answer about the housing, because Schiller said almost similar things about the housing. What's going on, he said.
Okay, so here's where the strength's coming in.
Where's the strength? Yes.
Okay, so we're to the point in the business cycle where growth is sufficient to increase revenues at both the state and the local level and the federal level. The federal level, we've got less fiscal restraint, so the net drag on growth is lower. At the state and local level, they're actually increasing spending for the first time since before the crash. So that's one source of strength. The second is, in part of our manufacturing base, the autos and aircraft industries are really doing well. The auto industry took the opportunity to retool, reset wage contracts, and these are much leaner, more profitable companies. Boeing, who's our civilian aircraft company, as we would say in American sports parlance, is ripping the cover off the ball. They can't do anything wrong. They're doing so well from both a domestic standpoint and in terms of their external demand, that these are some of the primary drivers of growth here in the economy. And even if housing's not growing at the pace it did over the past 24 months, housing will grow, but it will just be at a lower, more sustainable pace.
Thank you so much. And that was my last question. Thank you. Have a great weekend and I return it to Istanbul. Evet, burada sohbetimiz sona erdi. Söz tekrar sizde İstanbul'da. İyi hafta sonları Hande.